Let's jump right into this explainer. Today, we're taking a standard stack of raw financial data and transforming it into a really clear roadmap of a massive strategic transformation happening right now in heavy industry. We're unpacking International Paper's Q2 2026 earnings. So if you want to understand exactly how a legacy giant pivots for the future, and honestly what that means for the broader industrial landscape, you are absolutely in the right place.
Here's our quick agenda for today. First up, Enterprise Q2 highlights. Then we'll look at North America's growth engine, followed by EMEA's strategic transformation. And finally, we'll wrap up with the financial outlook and step up. Let's get into it.
Starting off with Section 1 Enterprise Q2 highlights.
Okay, so the crucial point here is this central corporate narrative you're seeing. And I want to be clear, this isn't just some corporate buzzword slogan. This is a highly specific mathematical formula that management is actually using to actively restructure and optimize their assets for long-term growth. It goes like this: cost out plus capital investments plus focused execution equals sustainable improvement. Literally, every move they're making across the globe right now ties directly back to this one equation.
And we saw that exact formula play out incredibly clearly in the second quarter. Their disciplined execution translated to a Q2 enterprise scorecard featuring a massive $6 billion in net sales. Right in the middle of all that, we see a really solid 9.8% adjusted EBITDA margin. That totals $587 million in earnings. So even amidst pretty heavy maintenance and constantly shifting global dynamics, their foundational execution really held strong.
Now, this beautifully sets up two very contrasting strategic postures across the globe. We're essentially looking at a tale of two entirely distinct operational strategies here. Over in North America, they are laser-focused on growth, grabbing market share and advancing those strategic investments. Meanwhile, in MEA, they're leaning hard into lean optimization, they're shrinking their footprint, and aggressively executing a planned corporate separation. It's just a fantastic example of a business really tailoring its strategy to the specific on-the-ground realities of its regional markets.
Moving right along to Section 2, North America's growth engine.
This is where the growth story really gets compelling, folks. North America isn't just riding some broader market wave, they're actually outperforming market demand entirely. We're looking at a 1.7% volume increase year over year for Q2. And get this, they expect to outpace the broader industry by about 2% for the full year. What makes this so impressive is that mill performance improved by 5% year over year. And they pulled off this disciplined execution during a quarter that had double the normal amount of planned maintenance outages. I mean, that is top-tier operational resilience right there.
So to fuel this ongoing growth and really keep that momentum going, they're aggressively upgrading their portfolio. They're making these strategic investments that literally timeline perfectly through the rest of 2026. For example, they closed the Dover acquisition in May to strengthen their regional footprint. That was followed up very quickly by the Norpak acquisition in June. And looking ahead to the fourth quarter, they are fully scheduled to begin operations at their state-of-the-art Waterloo Greenfield plant.
And here is the actual physical reality driving those impressive numbers. You've got the massive Norpak facility, which was a highly strategic acquisition targeted specifically to serve the booming demand for lightweight, high-performance grades out on the West Coast. And then you see the sheer scale of their heavy machinery investments, like the Riverdale machine conversion. That conversion is now completely ramped up and seriously strengthening their advantage cost position. This right here, this is what smart capital deployment looks like in the real world.
Let's shift gears to Section 3, EMEA's strategic transformation.
Now, while the broader corporate separation of the EME division is progressing exactly as planned, the business definitely isn't just sitting idle waiting for it to happen. They are operating with a rigorous 80-20 mindset. And well, what does that actually mean for them? It means they are ruthlessly evaluating their current assets, they're carefully optimizing their footprint, and they are redeploying capital only to the sites where it's going to have the absolute highest impact and return.
To pull this off, they're executing a highly targeted regional playbook. In Italy, down at the Lucca mill, they've made this transformational investment in a brand new recycled paper machine. It produces lightweight paper with significantly better emissions and way lower energy consumption. Over in Germany, the strategy is all about relentless cost-cutting, footprint optimization, and driving down fixed costs. But it's not all just cuts. Over in Romania, they are actively enhancing capacity to capture market share in a geography that actually offers much higher regional growth. So it's a highly nuanced, completely country-by-country approach. And the financial payoff for these tough, systemic optimizations? It's staggering.
Thanks to this 80-20 mindset, International Paper has announced over $210 million in run rate savings to date just in the EMEA region. But that kind of money doesn't come easily. It's the direct result of a massive operational footprint reduction. We're talking about closing 32 facilities across packaging, paper, and corporate functions. That resulted in a net headcount reduction of over 3,000. It's a much leaner, far more focused operation now.
So, taking a step back for a second, we have North America aggressively growing and capturing market share on one hand, and EMEA getting incredibly lean and optimizing its assets on the other. It really begs the vital question for anyone following this company. How does all of this set up the financial reality for the remainder of the year?
Let's answer that in Section 4, Financial Outlook and Step Up.
Okay, let's break down this complex earnings bridge from the first half of the year to the second half in North America. We can see exactly how the strategic positive drivers are just far outpacing the macro headwinds. You've got $380 million coming in from positive price, volume, and seasonality. The timing of planned outages shifting, that brings back $150 million. Those 80-20 initiatives and productivity improvements we talked about add another $120 million. And the Riverdale ramp-up contributes $100 million. So even when you subtract the $150 million in macroeconomic offsets, things like diesel, natural gas, and medical costs, you are still left with a massive, expected $600 million step-up in earnings for the second half. That is huge.
Now, while the overall 2026 outlook remains remarkably strong, they're projecting roughly $2.35 to $2.45 billion for North America, it is definitely worth noting one specific temporary operational hiccup in Q3. Basically, there's an estimated $85 million headwind stemming from a temporary suspension of operations at their Pine Hill facility. They had to repair a roof. But actually, this is prior to expected insurance recoveries, so it's viewed very much as a temporary, isolated event rather than any kind of systemic issue.
As International Paper executes this incredibly balanced approach, pairing that targeted geographic growth and those acquisitions in North America with the absolutely ruthless asset optimization and separation prep in EMEA, you really have to wonder about the broader implications here. Will this specific formula of cost out plus capital investments plus focused execution become the definitive blueprint for heavy industry transformations over the next decade? It certainly gives us a whole lot to think about regarding how legacy companies don't just adapt, but actually thrive. Thanks so much for joining me on this explainer, and as always, keep learning.